Okay, so the first thing, if you're going to go buy some rice in the market, you're going to know what is the price per kilogram. So the first thing is that if you're going to buy a stock, at least know what you can buy the whole company for. And most investors don't have that knowledge, which is amazing. And so the first thing an investor ought to ask themselves before they buy a stock, even before we get to price and so on, is this within my circle of competence?
Think about it. How often do we buy a stock without truly understanding the value of the entire company? It's wild, right? That's exactly what Mohnish Pabrai is warning us about. Most investors dive in without asking the most basic question: is this company even worth my time? So how do you find the answer to this basic question? For this, you need to know more about Mohnish Pabrai's approach to investing. In this video, how does he stay so grounded in his circle of competence while the rest of the market chases hype? What's he selling? What's he buying? And most importantly, what should you do? Mohnish Pabrai's success is built on 3 foundational principles: patience, precision, and payoffs. His investment philosophy is refreshingly straightforward yet immensely powerful. Buy $1 worth of value for just 50 cents. While many investors are distracted by market trends and short-term noise, Pabrai stays focused on long-term fundamentals, a strategy that sets him apart. Patience is perhaps Pabrai's greatest strength. He approaches investing with a timeline that spans years, often waiting 5 to 10 years for an investment to mature fully. A prime example of this is his stake in Rain Industries, an industrial company in India. Pabrai invested in the company when it was trading at a dirt-cheap price of around 60 cents per share. While others overlooked it, Pabrai saw the potential. Over 5 years, the company's stock price soared by over $7. That is over 10 times return, or 1,000% return, proving that patience combined with conviction can yield extraordinary results. Equally critical to his strategy is precision. Pabrai doesn't believe in holding dozens of stocks to diversify away risk. Instead, he zeroes in on a small number of businesses that meet his strict criteria. As of last year, his portfolio was concentrated in fewer than 10 companies, with over 80% of his holdings in just a handful of them. This high-conviction approach allows him to deeply understand each business, making calculated bets rather than spreading himself thin. Another key pillar of his success is his focus on cash flow. Pabrai values companies that consistently generate free cash flow, which serves as a buffer during economic downturns and a reliable source of returns for shareholders. For instance, his investment in Shockmarketler, a Turkish grocery chain, backs this principle perfectly. The company offers a dividend yield of 6.5% and has stable revenue growth, making it an attractive, undervalued asset in a market that many investors shy away from. Pabrai also relies on specific metrics to guide his decisions, such as companies with PE ratios under 12, healthy free cash flow, and low debt-to-equity ratios. By adhering to these benchmarks, he makes sure that his investments are rooted in value and shielded from excessive risk.
So what I've learned, one of my biggest mistakes has been is selling too early. I have watched 100 baggers that I bought who went on to become 100 baggers so many times after I was out. And I'd only captured the double or the triple, and I didn't capture the remaining 98 or 97 times that it went up.
But when you buy, you don't know it's going to be a 100 bagger.
Absolutely. In fact, you learn about a business only after you own it. So you may do all the analysis in the world, but you're really going to learn the business after you own it.
Mohnish Pabrai's knack for timing investments isn't about predicting trends. It's about exploiting market mispricing caused by short-term panic or neglect. His approach, often termed time arbitrage, thrives on recognizing undervalued assets during periods of uncertainty. And interestingly, even U.S. economic policies have inadvertently contributed to some of the opportunities he has seized. Take Turkey, for example. In 2024, as Turkey grappled with inflation surpassing 45% and a struggling lira, most global investors steered clear. However, the Federal Reserve's aggressive interest rate hikes in the U.S. played a role in intensifying capital flight from emerging markets, further depressing valuations. Pabrai saw beyond the macroeconomic chaos, investing in Şokmarketler, a Turkish grocery chain with a 6.5% dividend yield and stable revenues. While U.S.-focused investors fretted over the strong dollar's impact on global markets, Pabrai capitalized on these discounted assets. Similarly, his investments in India's small-cap sector are indirectly tied to shifts in the global economic landscape. With U.S.-led trade wars and reshoring efforts impacting global supply chains, India emerged as a key beneficiary of diversified manufacturing hubs. What sets Pabrai apart is his ability to act when others hesitate. When U.S. markets are flush with liquidity or distracted by speculative sectors like AI or crypto, Pabrai shifts his focus to overlooked global opportunities. His success lies in recognizing when U.S. economic trends create ripple effects that undervalue high-quality businesses elsewhere, turning temporary dislocations into massive long-term gains. It's not about beating Wall Street. It's about playing a different, smarter game.
If the job is done right, it never needs to be sold. And what we should really be thinking about is when we invest, we should think of it like a family business that can never be sold. So if, Buffett uses the analogy of a punch card, he says that you have a card which has 20 punches and then you can't punch it anymore. He said each time you buy a stock in your whole life, you punch it once. And when you've bought your 20th stock, you cannot buy any more stocks. So if that was a rule that was imposed on you, you would think long and hard about each stock. And one of the things you think about is, can I live with this forever?
And that's exactly what sets Mohnish Pabrai apart. While others chase trends or overtrade, he plays a smarter, more disciplined game. His ability to focus on long-term fundamentals rather than short-term noise is what drives his success. But even with this patient approach, Pabrai knows when it's time to make a move, and that includes selling. Pabrai isn't the type of investor to sell a holding without a clear and calculated reason, and his recent 13F filing decisions highlight his disciplined approach to optimizing value. First on the chopping block is Arch Resources Inc., a coal producer that was once a significant part of his portfolio. In Q3, Pabrai reduced his stake in Arch Resources by 92.1%, selling 31,002 shares valued at approximately $4,283,000. This marks a dramatic exit from what had previously been one of his largest holdings, representing now only 1.7% of his portfolio earlier in the year. Why sell? One possible reason is the stabilization of coal prices. While coal demand remains steady, the market may now be pricing in lower growth potential, reducing Arch Resources' attractiveness relative to other opportunities. Pabrai may also have viewed the company as nearing fair valuation, prompting him to reallocate his capital into higher conviction investments. This aligns with his recent moves into other energy-focused companies like Core Natural Resources, where he significantly increased his position in the same quarter. More on that later. Pabrai's decision to sell isn't a reaction to fear or uncertainty. It's about opportunity cost. Every dollar in his portfolio must be positioned for maximum returns. By divesting from Arch Resources, he frees up capital to reinvest in businesses with better growth potential or more favorable valuations. Mohnish Pabrai's buying activity last year signals a decisive shift toward industries benefiting from global macroeconomic tailwinds and undervaluation. His investments in coal, energy, and shipping underscore a strategy rooted in finding sustainable, cash-rich businesses operating in sectors with long-term relevance. Let's start with the standout. Core Natural Resources, formerly known as Consul Energy. Recently, Pabrai added a massive 598,604 shares of CNR, bringing his total stake to 770,642 shares valued at approximately $80,648,000. This move made it one of his largest holdings, representing a significant 32.66% of his portfolio. Why Core Natural Resources? As a leader in coal and natural gas production, the company has consistently delivered robust free cash flows, even in a challenging energy market. With global coal demand projected to remain above 8 billion tons annually through 2025, CNR is poised to benefit from sustained energy shortages and increased demand for reliable fuel sources. This isn't solely because of rising energy prices, it's also a calculated investment in a business with strong fundamentals, predictable revenue streams, and significant market resilience. Next up is Warrior Met Coal, where Pabrai increased his stake by 48.12%, adding 226,888 shares. His total holdings now stand at 698,407 shares, valued at approximately $44.63 million, making up 18.08% of his portfolio. Warrior Met specializes in producing high-grade metallurgical coal used in steelmaking. While metallurgical coal prices can be cyclical, Warrior Met's strong financials and operational efficiency make it a standout in the industry. With global infrastructure demand driving steel production, Pabrai's increased position in Warrior Met reflects his long-term confidence in the sector's stability and growth potential. Pabrai's portfolio also saw a modest increase in his holdings of Alpha Metallurgical Resources Inc., AMR, with an additional 3,545 shares purchased. This brings his total to 479,698 shares valued at $113,295,000, making AMR his largest holding at 45.89% of his portfolio. Alpha Metallurgical is also a leading producer of metallurgical coal. The company's high free cash flow, robust balance sheet, and strategic importance in global supply chains make it a cornerstone of Pabrai's strategy. Last but not least is Danaos Corp., a fresh addition to Pabrai's portfolio. He purchased 46,590 shares valued at approximately $4,004,000, representing 1.64% of his portfolio. Danaos operates a fleet of container ships and benefits from stabilized charter rates and expanding global trade routes. The shipping industry, often overlooked by mainstream investors, aligns with Pabrai's preference for undervalued, cash-rich businesses. With global trade expected to grow as emerging markets continue to expand, Danaos offers a unique combination of stability and growth potential, making it a perfect fit for his portfolio. But what can we, as investors, learn from Pabrai's moves? How can his strategy guide us through the complexities of 2025? With economic uncertainty and shifting market dynamics, his disciplined strategy highlights three key principles for investors. First, prioritize companies with reliable cash flow. In volatile times, businesses with steady earnings and strong fundamentals outperform flashy, high-growth sectors. Second, embrace fear-driven opportunities. Pabrai's contrarian mindset shows that market downturns are opportunities, not setbacks. When others panic, he steps in to find solid businesses undervalued by the market. The lesson: use periods of uncertainty to secure quality investments at discounted prices. Lastly, think globally. Pabrai's global approach encourages investors to explore opportunities beyond their home markets. Emerging economies often offer high growth potential and undervalued assets, rewarding those willing to expand their horizons. Want to know what Buffett is buying right now? Click the video on the screen to find out.